What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is January 4th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we're going to be spending some time to talk about a very important and fundamental principle to understand whether you're investing or trading. And it doesn't matter what market you're investing or trading in, whether it be Bitcoin, gold or silver, or equities, it's relevant across any investment you'll ever make. And it's something extremely simple to understand. And that is your risk to reward profile, or risk to reward ratio. So what is a risk to reward ratio? Why is it so important? And along with that as well, how are there different ways we can go about spotting these risk to reward profiles? Well, we're going to be talking about all of that and more in this video, but along with that as well, we're going to be having a sponsored review towards the end of the video for Render Network. So stay tuned for that. You won't want to miss it. All right, so let's just go ahead and talk about this at its core, guys. What is the key principle of a risk to reward profile or ratio? Well, they're interchangeable terms. It's the exact same thing, but a risk to reward ratio is understanding your potential loss, your risk in a trade. How much money could I lose entering into this position? But along with that as well, what is my potential reward, my potential return in this case for investing in this asset? When am I looking to sell my asset after I have bought it and held it for some time? And that's the general kind of thesis here of a risk to reward ratio. It's pretty self-explanatory here. It's the idea of what I can make on this versus what I can lose on it. And the idea on the surface, and a kind of a surface level analysis, is to make sure that I have a small amount of potential loss on an investment or trade, and I have a large amount of potential return. Okay? And the cool thing about this is that at the end of the day, we can never know where any given asset is going to go. We can have general theories, we can predict, we can have our assumptions in this case of where it's going to go, but we'll never know exactly when and where price is going to be. The cool thing about a risk to reward ratio, though, is that it gives us the ability to have a sense of predictability, a predictability as to how much we'll potentially lose, and to also know when we are going to take profit no matter what. It's our maximum level of potential return, okay? So that's the general thesis with this. Now that I've gotten that across to you guys, I want to go ahead and just give you a very brief kind of example here of what that would look like on a chart. And then we'll talk about a few different ways where we can actually go about finding favorable risk to reward opportunities. So there's a really cool set of tools here. I'm using tradingview.com, as you guys probably know about. If you haven't, it's a free website. It's a really awesome charting platform. And on there, on the sidebar, there's actually a tool here called a long position. Now, if you go into shorting and stuff, this is where you can use the short position, but I'm going to skip that for today because many people out there don't really tend to short. So if I was looking to make an investment in Bitcoin right now, for example, let's say I wanted to enter right here at $7,300. I want to make sure that as I invest in this, I have a general idea of where I'm looking to sell and also where I would potentially get out of the position so I don't lose all of my money, right? A default risk to reward ratio without any certain type of trading mechanics of either exiting on a bad trade or good trade is going to be in zero or the sky's the limit, right? And we don't want that. We want to have some sense of predictability, even if we're investing in something long term. All right, but let's just go ahead and give more of a short-term example here. So let's say, for example, I wanted to go ahead and enter into a trade right here at this current price of Bitcoin, right? So we can simply click on the chart here, and it's going to go ahead and give us two boxes here that we can move around. Our potential reward that we want to set, and then also our potential loss. And this is basically what would be known as a stop, or in this case, a stop loss. So let's say, for example, all right, that I believe Bitcoin could go up to $10,000. I'm going to move this here so I can get the exact level. So $10,000 is where I believe Bitcoin could go to. And that would be a 37% return here. Nice, good trade here. And I believe that it's going to happen here over the next few months, up into the summer. Let's say that this is the time frame I'm willing to be in this position. So in a couple of months, I might be able to make 37% of my money. But at the same time, I don't want to lose all my money if it goes south. So I'm going to go ahead and set a stop here at around $6,600 or $6,700. Okay, so I'm giving it some room to breathe just in case I didn't pick the absolute bottom in Bitcoin's price. And if it goes down here, I'm going to exit out of my position and take a small 9% loss. But the important thing to understand here is the difference between the risk and reward, right? The risk here is 9%. The potential reward I can make here in the next few months is 37%. And that's the really cool thing here, is that I have a favorable reward profile compared to my risk. So on the surface, this is how most people use risk to reward ratios. And there's nothing wrong with this. This is actually really probably the most important way you should look at it. Looking at straight price. And that's exactly what we're doing. We're not using any indicators. We're just simply making sure we map out our time frame and what potential reward and risk we're taking on. Now, another thing to take into mind is that we may not hit this target range, or we may not hit the bottom range down here. We might not get stopped out, and we also might not hit our maximum level in our time frame. It might just simply push a little bit sideways, or maybe still go up but not reach our full target. That's something that can happen, and you need to determine to yourself whether or not, at this range, here, for example, maybe if it hit 9100 here, maybe I'll just go ahead and take my profit. I've been in the position long enough, I made a return, time to walk away. Or maybe I decide to hold it more long term and maybe adjust my strategy. It depends, guys, on how you want to go about doing it. And it depends on your time frame. If you're long-term investing, a lot of this is going to be on a much longer-term time frame. We're taking a look at the weekly chart here on a very short time frame for Bitcoin, just over the course of a few months. All right. But I want to go ahead here and talk about how we can actually spot risk to reward ratios across the board in different varying ways. Outside of just looking at price, it's a bit surface level. So we want to go ahead and look at a few other examples. And what better person to use as an example than the legacy investor himself, Warren Buffett. Now, many of you out there probably know, whether you invest in stocks or just invest in general, you probably know about Warren Buffett, and you probably know about his company, Berkshire Hathaway, which is one of the largest companies in the world, and has its hands, or I would say tentacles, and many different directions in different industries. It's very well known for its investment positions that it's been holding, and Warren Buffett is known for this. He's a value investor. But Warren Buffett, interestingly enough, is a perfect caricature, a perfect kind of analogy to kind of summarize my point here about understanding risk to reward ratios. Because Warren Buffett, who is someone who's always been very bullish on markets, he's always bullish on buying when there's fear in the street and investing long term, actually has had his largest cash position at Berkshire Hathaway since before 2008. $128 billion in cash is sitting on the books for Berkshire Hathaway, and it's doing nothing. The crazy thing about this, though, is that this tells a lot about Warren Buffett's belief, whether he says it or not in person. It shows it through his actions that he believes that equity markets right now are not at a favorable risk to reward profile to make new investments. That's a very key thing to take away, because if there's cash sitting there, you have to factor in the fact that there's going to be inflation, which is going to devalue the purchasing power of those $128 billion. And along with that as well, Warren loves a good yield. He loves to be able to find an investment that pays him year by year. And it's showcasing with that $128 billion just sitting there. He obviously doesn't see that value, or at least see adding in at this range as a valuable proposition into stocks, which are the market that he invests in. He invests in equities. So this is an important thing to take a look at here. And I'll go ahead and pull up the chart here so you can see a little bit clearer. They call it, this is something over from one of my favorite websites, Advisor Perspectives. It's called the Buffett indicator. And this is something that I look at a lot of the time. And I look at it across different market indices, but it's a ratio here. Again, talking about ratios at the end of the day, between corporate equities, the value of equity markets as a whole, to GDP. Right? So which one is growing more? Are we seeing equities growing? Are we seeing the assets that define these companies of the economy going higher in value versus the growth in GDP? And this is very important to understand, because it can give us some understanding here as to whether or not equities are overvalued as an asset class, or they're on the lower end. They might be undervalued. Well, we can see here, generally speaking, between history, there are general ranges where valuations trend compared to GDP for equities. And we can see here back, for example, during the dot-com bubble. This is when the internet boom was blowing up during the 90s, leading up to the new millennium here in 2000. And what we saw was equities were outpacing GDP on a mass level. Basically, equities were valued at 161% comparative to GDP, the entire gross domestic product of the economy. So we were basically evaluating the companies themselves at a higher level than the amount of economic output they put every year, right? In the sense of total GDP. And this was unheard amounts of levels in this case. And now here, as we're nearing, in this case, now we're in 2020, the chart is back from the last quarter of 2019, we can see here that we were sitting at about 144%. So not as high as the dot-com era, but we can see here, generally speaking, that there are general ranges where value comes in, right? We can see back here in the 50s and the 80s, it's around 32, 33%, and we generally topped out around a range of 80%. And nowadays, 80% is around the bottom here, where we usually can find value, anywhere between the 65% range to 80% range. This is where it would be much more favorable because you're buying in at a range where equities are at a much lower value comparative to the real fundamentals, the GDP, the gross domestic product of what these companies are actually producing, what make up the economy. So Warren, in this case, is looking likely at indicators like this, and he's seeing that, wait a minute, equities are at one of their most overextended levels comparative to the fundamental GDP. So at this range, it's hard for him to find value because maybe it could go up here to 161%, maybe it could go even a little bit higher. But for Warren, as a long-term investor, he likes to add in these ranges down here. He likes to find when there's fear. He likes to find opportunities where, in this case, the market is scared, it's selling its positions, people are giving up on the long-term view, and he knows that he's picking up things at a discount, okay? So this is a very clear thing to look at here. And again, just some more charts here. This is the Wilshire 5000. It's another stock index. You can see here just the kind of ratios we're at right now. We're at very similar levels to where we were back in 2000. And understanding that makes it very clear to understand that we don't have a favorable risk to reward ratio in stocks. And this is why here on the channel, I've stayed clear stocks since back in 2018. And we've continued a little bit higher, to be completely fair, but we've done much better investing in other markets that had much more favorable risk to reward profiles like crypto. And also as well, we'll talk a little bit as we go here now into gold and silver markets. Now, this is not a normal chart you will find if you look up gold and silver. This is actually another ratio that we're going to talk about here, right? So again, we were talking about this principle of ratios in markets, right? We talked about corporate equities to GDP, but this is actually another way where you can find favorable risk to reward ratios using, yet again, ratios. I know I'm probably making you guys insane. If I am, drop a like on the video and drop a comment. Anyways, but let's go ahead and actually just kind of focus in on what this chart is. So this chart is actually a small equation here. It's actually adding gold and silver. So I'm trying to get a general kind of assumption of precious metal markets versus the S&P 500. So it's divided by the S&P 500. So we built a ratio here of performance. And we can see here that gold and silver back between the early 2000s up here towards 2011 massively outperformed equities or the S&P 500. So the S&P 500 being a broad index of the equity market or stocks, we can see here that gold and silver outpaced with a greater ratio, in this case, of growth over time compared to equities. And this is during a time where equities grew. Equities grew over time during this period of time, but gold and silver grew at a much faster pace and therefore grew to have a greater ratio. And then as it entered into a bear market, gold and silver declined. Now, let me ask you something. I want to get like your opinion and take on this, guys. Real time, what do you think you would want to take as a position here? Would you bet on gold and silver or the S&P 500 with the current ratio range that we're at right now? I just want to go ahead, give you some time to think about it. The interesting thing to take away is that, of course, this is subjective. Anyone can, again, look at this chart and have completely different viewpoints. But I would say that most traders and investors are going to look at this, if they were to see this for the first time, and say, yeah, this is a range where I would start to take more risk on gold and silver. Now, why is that? Well, because we're not towards the historical highs where gold and silver are way outpacing the S&P 500. Some might say, well, wouldn't you want to buy it when it's rallying, when it's strong? And that is true. You definitely do want to hold it once you're in these kind of lower ranges. And again, as it starts to tick up higher and pick up momentum, yes, you should be hopefully holding gold or silver during those time phases if you want to actually make a profit on gold and silver. But at the same time, you don't want to be buying when values are overextended to other asset classes, especially ones that have a sense of correlation with one another. And now that we're starting to see that we've had a long-term correction of gold and silver compared to the S&P 500 down to a support range where we've seen in the past, and we're also seeing higher lows here, it's showing that buyers are getting more eager for precious metals like gold and silver, that slowly but surely it's starting to outpace and turn the tide against equities in this case. And again, we're talking about equities being extremely overextended to their fundamentals, and we also have an asset class like gold and silver that's a hedge. We can start to see the trend starting to shift here between gold and silver and equities. So we can not only look at ratios with actual economic factors versus certain assets, we can also compare assets to one another. So this is the second way you can do it. And again, you can do this in TradingView. It's completely free. You just have to type in the formula properly in this case. And in this case, we wanted to get a general weight of the index of performance of gold and silver to the S&P 500. And we can see how the ratio changes over time. Last thing that we can take a look at is data science models. So for a lot of people out there who watch the channel frequently, when we talk about Bitcoin, we take a look at a lot of data science models because Bitcoin is very math-based. It's based in the fact that Bitcoin has a very predictable cycle of new issuance of Bitcoin. It has a fixed monetary policy, and that fixed monetary policy has effects on Bitcoin. Not to mention, there's so many other elements that go into Bitcoin and other different types of assets where data science models can help us get a very good prediction on where we're entering into an asset and whether or not we have a good risk to reward profile. So I'll give you an example here. This is the Puell multiple that takes into mind the daily issuance of new Bitcoin versus the 365-day moving average. So the amount of dollar value worth of Bitcoin being entered into the market. So if $500 million worth of Bitcoin is being issued into the market, and the average over time here, for example, was $1 billion in this case, you're going to have a lower ratio in this case, and it forms a specific ratio. So we can see here that any time we have the ratio come down here to about 0.3, this has been the time to pick up Bitcoin. It's literally picked the bottom 3 times in a row for Bitcoin. It's one of the most consistent data science models. So again, I'm not saying to go solely off of a data science model here, or for example, to look at the Puell multiple and say, historically we see when Bitcoin has its correction midway entering into the next cycle, that we should just go long off of this data science model. What I'm saying is, if we take into factor these data science models that we have available to us, we're taking in the ratios between different assets, seeing whether or not our asset is cheap compared to other asset classes, and along with that as well, taking in key models that take in fundamental data versus the certain asset class that we're investing or trading in, we can start to have a very clear picture as to what we're investing in and whether or not we have a favorable risk to reward ratio outside of simply just analyzing price. If you can do all 4 of those things, then you're going to be in a good position, and you're going to be way ahead of other traders and investors. I'll tell you one other additional just kind of tidbit here. Of course, I can't give you guys financial advice as to what you want to do, but I would say that if you take all of these elements into play on longer term investments, if you're a macro trader like myself and you trade for 1 year or more, in this case you're looking at something down the line, then you will be so well positioned comparative to other people. I can guarantee your potential for profit is going to accelerate much higher from those who are randomly guessing and short-term day trading. Period. End of story. The science is there. There have been studies on it. People have continuously lost out trading on smaller term time frames with little to no grappling on where they are and what they're investing in. That's the key principle to success, guys. And I hope you all enjoyed this key topic that we talked about. If you liked it, drop a like. But let's go ahead and dive into the sponsored review for Render Network. Alrighty, everyone, so let's go ahead and spend some time to take a look at today's sponsor, and it is no other than Render Network. Now, before we dive into the technical aspects of this project, I want to go ahead and give a very brief overview as to what Render Network is trying to achieve, but also understanding the key problem that it's trying to solve. So to start, I think many of you out there can relate to me in the fact that you probably share that love of animation. I've been a huge fan of animation since I was a kid, and I've been a big fan of major animation studios like Pixar that have really built some of the films that have shaped me as an individual. And the great thing about Pixar as a company is that it's one of many awesome creative studios that build these really engaging animations, these beautiful pieces of art that many people will remember for their entire life. But there's a big problem that companies like Pixar face, because there's the creative element of creating a film, and then there's also the processing, or rendering in this case, that actually brings it to life so that we can actually witness it the way the artist intends. So, for example, this is one of the many movies that Pixar's put together. It's called Inside Out, and this is a small 33-second clip that's on this website called The Science Behind Pixar. But many people don't know how much had to go into building this. There's a lot of lighting, there's animation, there's shading, and it's easy to do that on a computer temporarily, frame by frame. It's a lot of work, but you're able to do it on a computer. But the thing is, when it actually comes to production, it takes a ton of computational resources to produce this. This 33-second clip took 33 hours. Basically, every second took an hour of computers working constantly to produce frame by frame, piece by piece, this clip and the entire film. So when you're talking about an hour and a half to 2 hours, it's going to take a very long time. And this is what Render Network is trying to achieve at its core. But it's also trying to fix a few other issues, which we'll dive into. So let's go ahead and talk about some of these key things. So the first thing is network scalability. As we'll learn later on from one of the founders of the project, it's become very clear here that companies like Pixar and other animation studios, or those who require excessive computational power, are simply not able to get both the resources they need and the timeframes that they need, and also face a lot of bottlenecks from, actually, ironically enough, a centralized approach, which has been cloud computing or cloud resources. So because of this, there's been a very big need for a GPU market to form that can service the needs of companies like Pixar that are producing these very high-tier production pieces. Another thing as well is that there's been a missing GPU network. So right now, there's a very easy solution in this case, in the sense of where we actually get those resources. All of our computers, including mine that's sitting right next to me, have a graphics processing unit, a GPU, that is in most cases being unused. So even as I'm recording this video, I'm only using a fraction of my GPU. And because it's sitting there idly, there's a lot of power that isn't going towards doing something productive. So what we're doing in this case is we're building not only a network in this case to service other companies. So I would be able to do maybe a rendering job for some kind of company or project somewhere in a different state or a different country and be paid for it in render tokens. But along with that, I'm able to actually make use of my GPU. And this is a really good point here too. I think that's a little bit of a self-criticism to the crypto space, and I think it's fair. A big issue with crypto right now is that most of the processing power is going towards mining. As you guys might know, there's a lot of Bitcoin ASIC miners that provide the hash rate to the Bitcoin network. All they're doing is playing a guessing game to get a specific hash. That's all it's doing. It's not producing something of quality that we're going to enjoy or remember. And this is the cool thing about it. You're not only being able to earn, but you're actually producing for real world assets. And the cool thing here too is that the render network provides digital rights management. And this is a very big thing because it gives you the ability to have a verified proof that this is your creative work on chain. And in this case, you can not only prove that, but you can also properly monetize it. So all these things are just, checking off the boxes in my opinion. I think it's very exciting. And I'll be fair, there's been a few projects before that have talked about this concept, but I don't think there's been a crypto or blockchain-based project that is really taken upon this objective with the kind of skills and history backing behind the team. So we're really going to learn about that as we go through. So if you guys want, I'm going to leave a lot of links down below where you can learn more about the render token. But this is Jules Urbach, who's one of the founders of the project. He does a really good video just kind of introducing the general concept. And he's the founder of Atoy. So Atoy has been basically working in the rendering space for a while. They have Octane Render. You can actually go ahead and test out some of their technology. They have real rendering software, and in this case, they've been around in the industry for a while. Jules, for example, so we'll take a look at the team, has been in the space for 25 years. So they're not just stepping into this with a concept of merging blockchain technology with some industry. They actually know some of the needs that need to be served. So I want to go ahead and talk about these highlighted parts here. We have a lot of big technologies coming up with AR and VR. There's a lot of rendering that's going to need to be serviced, and a lot of new technologies like ray tracing that are making the details and the abilities of being able to make things lifelike. It's very dependent on being able to have these renderings. So let's go ahead and read through this. In order to support the emerging media of tomorrow driven by AR and VR, it's crucial to be able to bridge the gap between the promise of these breakthroughs and the feasibility of widespread access to them. This is why we are pleased to announce the Render Token, a blockchain-based worldwide rendering network where GPU work is spent and valued tracing photons, not hashing numbers. Again, making that picture of showing that, look, we're not just generating random hashes, we're producing and proving that we're actually producing valuable work or proof of useful work. This has been a concept that's been discussed in crypto for a while. Our aim is for the render token to make the process of rendering a streamlined photorealistic simulations and services easy and accessible to everyone. It will allow complex GPU-based render jobs to be distributed and processed on a peer-to-peer network, so they can go from building 3D assets to entire 3D environments. And this is the cool part, guys. There's so much aspects with VR coming around the corner into the mainstream here in the next few years. There's countless possibilities. And again, going on the other point of what Render Network provides, being able to say at the end of the day, hey, I produced this asset. All these people, for example, could have rendered it for me, and I have a verified proof on the chain that this is my asset, and I can monetize off that. I can distribute it and open it up to other individuals. And this is a big thing here. It's highlighted in another one of their Medium articles called A Photon-Driven Economy. What really stuck with me is the ability in this case to be able to monetize authorship. So this is a good example. I think they'll really sell it. So Otoy provided a window into its functionality through a collaboration with a man named John Carmack and Disney back in 2016 when they were working with the Oculus ecosystem or Oculus Social. And they basically showcased that you could basically provide and open different types of worlds to other users on the Oculus network through a room ID. So this is similar to a web domain. So if I was to go, for example, as they mentioned at Disney.com, I'm going to be presented with a specific web page. In the case here on the Oculus network, they were able to provide it where I would be able to showcase or share worlds that I build. And you could be able to build some great and creative things, and it might take you a lot of time. And sometimes you might want to monetize those great experiences. So this is the really cool thing, having ownership, being able to monetize, and also being able to allow a decentralized network, not some centralized platform or cloud company producing all of these things, giving an ability for you and I to be able to earn when our computer is not being used. There's no net negative to it outside of possibly power costs. So that's the really cool thing. And what I like here again is that there's experience with a toy here. There's actual products here that people can use right off the bat. So if you guys want to go ahead and explore some of their tech to learn a little bit more, feel free to not only check out Render Network's website in this case and learn more about the Render token, but also study Otoy as a company and see some of the work that they've done. They've done a lot of fascinating stuff, and one of the things they think it's important, again, is always to look at the team. As we talked about, Jules here has worked in the industry for over 25 years. You can tell he was at a young age. He was a go-getter. At 18, he was already making his first 3D video game platform that was licensed to a ton of companies like Disney and Nickelodeon and Warner Brothers. I think this is just fascinating stuff. And not to mention, big plus here, getting Brendan Eich on the team. If Brendan Eich is on here, it gives me a big sense and boost of confidence as to what Render Network's trying to do, because they led the BAT project, as you guys know, the Brave browser, which has been one of the most successful projects in the cryptocurrency space. I'm using it right now, and I gotta say, this is a really good stacked team, and it's nice you can actually check out some of the details on some of these members. But again, do some research on it, guys. I think the concept is there. Again, I've seen this before. I've seen this idea before. I think it's just a matter of really being able to pair it, not only by building a network in this case, but being able to take upon the benefits of digital asset rights in this case, being able to have ownership, and then also being able to pair it with the great software that they've built over the last few years. But I'd like to know what you guys think. If you guys got anything to say, leave a comment down below. And if you guys like this video, drop a like and check out the links down below to do some further due diligence and research if you want to learn more about the project. That being said, everyone, thank you all so much for watching, and I'll see you all in the next one. Stay tuned.